Ever wondered how geopolitical tensions can impact your investment portfolio? Today we delve into this complex subject. The world of investments is like a complex web where each thread is interconnected. When one thread gets disturbed, the entire web feels the impact. In this case, the disturbance is geopolitical tension, and its ripple effects can be far-reaching. Geopolitical tensions have a significant impact on global markets. They create an environment of uncertainty, making investors wary and often leading to volatility in the markets. This uncertainty can affect various asset classes, including equities, currencies, and commodities. Let's start with equities. When geopolitical tensions rise, stock markets tend to react. Fear and uncertainty can lead to knee-jerk reactions, causing stock prices to fluctuate wildly. In some cases, investors might rush to sell their stocks, leading to a sharp drop in prices. This is especially true for sectors like defense, energy, and technology, which are sensitive to geopolitical instability. Next, we have currencies. During times of geopolitical tension, investor sentiment in the currency market takes a hit. Safe haven currencies, like the US dollar, often strengthen as investors seek refuge from economic uncertainty. Conversely, other currencies might weaken due to perceived risks. Then there are commodities. Geopolitical tensions can disrupt supply chains, leading to fluctuations in commodity prices. For instance, if tensions escalate in a major oil-producing region, the price of crude oil could skyrocket. In times of uncertainty, investors often realign their portfolios, moving away from riskier assets and seeking out safe haven assets. These are assets that are expected to maintain or increase in value during market downturns. Examples include gold, government bonds, and certain currencies like the US dollar. The current turmoil in the Middle East, sparked by the Iran-Israel conflict, provides a compelling case study of this phenomenon. As these two nations engage in a military tussle, the world watches anxiously, bracing for the potential fallout on global trade, economy, and of course, investment portfolios. To understand the potential impact on your investments, we first need to understand the conflict itself. Currently, the Middle East is in a state of upheaval, with Iran and Israel at the forefront of this turbulence. Recently, Iran launched an attack on Israel, using hundreds of drones and missiles. The attack was, according to Iran, a response to a strike on its consular building in Syria. The strategic importance of these two countries in the global political and economic landscape cannot be overstated. Iran, a major player in the global energy sector, and Israel, a dominant force in the global defense and technology areas, both hold significant sway in global affairs. Any instability in these nations can send ripples through markets worldwide. In the wake of these attacks, global financial markets are already showing signs of unrest. Investors are watching closely, bracing themselves for potential aftershocks. The fear is that if this conflict escalates into a full-blown war, the consequences could be far-reaching and deeply destabilizing. The Middle East has already endured the effects of the Israel-Hamas conflict for several months. A full-scale war between Iran and Israel could exacerbate this instability, leading to further complications for the global economy and trade. The potential for panic selling in markets is high, as investors grapple with the uncertainty of an escalating geopolitical crisis. But the impacts of this conflict won't be limited to the Middle East or to these two countries. As we've seen time and time again, geopolitical tensions have wide-reaching effects on various asset classes, from equities to currencies to commodities. Investors worldwide could find their portfolios at risk as they navigate the choppy waters of a global market in turmoil. In the coming segments, we'll delve deeper into the potential impacts on equities, currency markets, and precious metals. We'll also discuss strategies for investors to potentially safeguard their portfolios in these uncertain times. But for now, it's clear that the escalation of this conflict could have far-reaching effects on global trade and economy. Global stock markets are sensitive to geopolitical instability. Let's examine how this conflict could affect equity investments. It's no secret that markets are skittish creatures, prone to react sharply to sudden changes in the world. In the face of rising tensions between Iran and Israel, we could see knee-jerk reactions and potential panic selling in the markets. This is a common response to geopolitical instability, as investors scramble to protect their assets from unpredictable shifts. As the conflict unfolds, we may see some sectors particularly affected. These are the areas that have direct links to Iran and Israel, for instance, defense, energy, and technology sectors. Let's dive a little deeper into why these sectors are so crucial. Iran is a significant player in the global energy market. Should the conflict escalate or prolong, it could disrupt oil production and supply, causing a ripple effect on energy stocks worldwide. Furthermore, any disruption in oil supply often leads to a surge in oil prices, which could further destabilize the stock market and economies reliant on oil imports. On the other hand, Israel is recognized globally for its influence in defense and technology sectors. An unstable Israel could mean a shaky foundation for these sectors. Defense companies could experience a surge in demand, but also face the uncertainty of a volatile geopolitical landscape. Technology stocks, a favorite among many investors for their growth potential, could be hit as well, given Israel's significant contributions to global tech innovations. In essence, the interplay between these sectors and the escalating tensions could lead to significant volatility in equity markets. However, it's important to note that markets are complex systems influenced by a myriad of factors. While we can predict potential impacts based on historical patterns and current information, the actual outcomes may differ. The reactions of risk-averse investors will be critical in shaping the market's response. These investors who prefer lower-risk investments may decide to pull back, causing a drop in stock prices. On the flip side, those willing to ride out the storm may find opportunities amidst the chaos. As always in the world of investing, it's a delicate balancing act between risk and reward. In times of uncertainty, currency markets also experience significant fluctuations. This is a key factor to consider, as these shifts can have profound impacts on your investments, particularly if you hold assets in a variety of currencies or if your portfolio is heavily reliant on certain economies. When tensions rise and economic stability is threatened, investors often seek refuge in what are known as safe haven currencies. The US dollar, for example, is considered a safe bet during times of geopolitical unrest. Its powerful global standing and the strength of the American economy make it a reliable choice for investors looking to shield their assets from volatility. In the face of the Iran-Israel conflict, we could see the dollar strengthen as more investors flock to its relative safety. On the flip side, not all currencies fare as well. Those considered more vulnerable to risk could weaken in response to such tensions. The Indian rupee, for instance, might come under pressure due to a potential rise in crude oil prices. Iran is a major player in the global oil market, and any disruption to its production or supply chain could send shockwaves through economies dependent on its output. This could lead to a devaluation of the rupee, which would have an impact on any investments connected to this currency. So, what does this all mean for your investment portfolio? Well, if you have assets tied up in currencies that are likely to weaken, you might see a decrease in their value. Conversely, if you have investments in safe haven currencies like the US dollar, you could see their value increase. It's a delicate balancing act, and one that requires careful monitoring of the global political climate and its impact on currency markets. Remember, currency is just one piece of the investment puzzle. It's important to consider the broader picture, including the potential impacts on equities, commodities, and other asset classes. The currency market's response to the conflict will have a direct impact on investment portfolios. In times of market volatility, investors often seek refuge in bullion. Gold and silver, the shining stars of the bullion world, have long been considered safe haven assets. But why are these metals viewed as such? The answer lies in their inherent characteristics. Gold and silver are tangible, finite resources that hold intrinsic value. Unlike fiat currencies, they can't be printed at will by governments. This makes them a reliable store of value, particularly in times of economic uncertainty or instability. Consider the current situation. The escalating tensions between Iran and Israel are causing ripples of uncertainty across global financial markets. In the face of such turmoil, Risk-averse investors are likely to shift their focus from volatile assets such as stocks and currencies to more stable alternatives. And that's where gold and silver come in. Gold, in particular, has a history of performing well during periods of geopolitical strife. Its price often rises in response to events that cause the value of paper investments, like stocks and bonds, to decline. Silver, although more volatile than gold, follows a similar trend. Its price is also influenced by industrial demand, adding another layer to its appeal as an investment. So, as geopolitical tensions rise, we can anticipate a surge in demand for these precious metals. As more investors turn to gold and silver for their stability and reliability, their prices are likely to increase. This potential rise in prices presents an opportunity for those who hold or are considering investing in gold and silver. However, like any investment, gold and silver come with their own set of risks. While they can offer some protection against volatility, they are not immune to fluctuations in value. Therefore, a balanced approach to investment, considering a mix of different asset classes, is always recommended. In uncertain times, precious metals can offer a measure of security to wary investors. They have proven their worth as safe haven assets time and again, and the current geopolitical scenario may once again highlight their importance in a well-rounded investment portfolio. Let's recap what we've discussed today about the potential impact of the Iran-Israel conflict on investment portfolios. We've delved into the potential knee-jerk reactions of global stock markets due to these growing geopolitical tensions. Investors, understandably anxious about the fallout from Iran's military attack on Israel, could trigger panic selling. This reaction is particularly likely in sectors sensitive to geopolitical instability, such as defense, energy, and technology. Israel's dominance in the global defense and tech sectors, coupled with Iran's status as a significant global energy player, underlines the potential volatility of these markets. We've also examined the potential impact on currency markets in times of turbulence. Safe haven currencies like the US dollar tend to strengthen as investors seek refuge amid economic uncertainty. Conversely, other currencies can weaken due to perceived risks. For instance, the Indian rupee could come under pressure due to higher crude oil prices, with Iran being a major producer. Turning to commodities, we've highlighted how investors often seek refuge in precious metals like gold and silver during market volatility. As investors shift from riskier assets to these safe haven assets, the demand for precious metals is expected to rise, potentially leading to an increase in their prices. In summary, the Iran-Israel conflict could have far-reaching effects on various asset classes, including equity, currency, and commodities. However, it's important to remember that these are potential impacts and not certainties. The situation remains fluid, and the actual effects will depend on various factors, including the duration and intensity of the conflict and the response of global markets and governments. While the situation is fluid, being aware of these potential impacts can help investors make informed decisions during these uncertain times.